is reason to be optimistic. So, the crystal ball, and in 2023, these are some of the reasons. Firstly, the momentum from an historic jobs recovery could help the US skirt a recession. That's why the IMF didn't say the US would be. Inflation may have peaked and seems to be cooling, the latest numbers suggesting that. Gas prices considerably lower from last year's highs. But then, of course, you've got the problem of Ukraine. Real wages are growing faster than consumer prices. That's good at one level, more power. But of course, that boosts inflation as well. And the Fed has signaled they could slow rate increases. Rana is with me, the associate editor at the Financial Times. Now, I'm not having any miserableness. No misery here. We're looking forward with optimism and bon vivant.
Well, all right, let me be optimistic to start. The US won't do as badly as the rest of the world. That's optimistic, right? We're seeing a little bit of wage growth. We're seeing a little less inflation. We've already seen a 20% collapse in the market. So how much more can we get this year? Probably not that much more. But Richard, I mean, a third of the world is going to be in recession. So we can't be too optimistic about 2023.
Okay. The worrying part about that, we'll come to the rest of the world in a minute. I want to stay with the US for 1 second. This, we're bouncing along the bottom, arguably, of the market. And I suppose the only issue is whether we test last June or October's lows. You can see them on the chart. We can see them on the chart again. It was November when we tested new lows. Are we likely to see and test those again? We don't know.
We don't know. And, one of the things that I'm watching really closely is a lot of corporate debt is going to start coming due this year or this coming year, next year. And that's one of those points where, as Warren Buffett says, you see who's been swimming without their shorts on. I do worry that if you start to see a bigger hit in the stock market in particular, that starts to hit U.S. growth at a more fundamental level. Because, Richard, over the last few decades, we have become such an asset-based economy here in the U.S. that when asset prices go down, that's going to have a real effect in the real economy.
This is really the first full throttle bear market in decades, in a sense. I mean, I don't count the pandemic because, that was an exogenous event with a sharp blip back. 2008, arguably, but even then, but this real in the trenches, sludging our way through, hasn't happened for decades.
No, and that's such an important point. So much financial reporting is about, we're going to be in a recession this quarter, next quarter. Well, we haven't really felt, as you say, that hardcore slowdown until, since arguably the great financial crisis. Certainly COVID was not that because there was so much fiscal stimulus in the system. So the sad truth is we're due for a big hit. Now, that said, a lot of balance sheets are in better shape than they were at previous points in history, like the financial crisis.
Now, see, I'm going to take that as a really good point. Because when I think of all the debate and discussion over, highly technical things at the BIS on ratios and bank ratios and all of those sort of things, the reality is neither the pandemic nor this recession has had, at least in the developed economies, maybe the UK had a wobble on pensions, right. but you know what I mean. But there's been no systemic risk to the system.
That's right. And, I guess we could say that's the legacy of 2008. Banks cleaned up their acts.
Yep.
Consumers, to the extent that they can, clean up their acts. I think the only place that there's risk that we maybe don't completely understand is the shadow banking sector. We've seen private equity start to look a little shaky. Crypto, certainly, having a meltdown. So some of those areas that are less regulated, maybe, but I don't see this as a Lehman Brothers moment. I really don't. I think that if we see a big hit, it's going to be more about the real economy pushing down markets and then that having an effect on consumer spending, housing prices, et cetera.
Rana, it's always lovely. Thank you. Thank you for the service that you've done in the gone by, and thank you in advance for all the times we're going to talk to you over the year ahead. I don't know whether you'll be in Davos. If you are, we'll catch up then properly. So it'll be good to see you whenever. Thank you.